Welcome back to the How to Financially Prepare to Buy a Home series. This is part 5, student loans. Now, just like the 20% myth is dead wrong, so is the myth that you can't possibly get a home loan if you've got a big student loan debt. And this year, there have been more major updates to the way student loans work with homes than I have seen in my 20 years. And what you do with your student loan could be the key to getting approved to buy a home. Let's go.
How to Buy a Home educates, protects, and connects first-time homebuyers to qualified vetted realtors in their area. Whether you're looking for DIY information or step-by-step guidance, How to Buy a Home is the #1 resource for first-time homebuyers.
What's the happy haps? How to Buy a Homies? I'm David Sidoni, and this is part 5, student loans. Today's episode, oh my goodness, we are loaded. I've got tons of student loan information that's brand new, and there aren't a lot of people out there reporting it. And as a first-time homebuyer, this is stuff you need to be aware of. So first up, you got to know I'm in your corner. I'm not sugarcoating anything about student loans. Student loans suck. And if you look at home prices and interest rates from 2021, then you know what? Today's housing market kind of sucks too. Student loans, they aren't going anywhere. And for the next few years, neither are the home prices or the interest rates. So what we're going to do today is fully embrace the suckiness of your student loans and the suckiness of the housing market. And we're going to find solutions. I'm here to offer how you beat a stacked game against you. My weapon of choice is a whole new strategy, and my magic sword I'm going to use is math. So right off the bat, do not believe the bogus myth that student loans are keeping you from buying your first home. They're not. And I have the stats and the stories to prove it. Student loans only keep uninformed buyers from buying a home. But the buyers who get the new strategies for this new economy, you're going to be playing chess while everyone else is playing checkers. That's going to be the first half of this episode. And then the second half of this episode, damn, get ready for some intense education. I've recorded a bunch of different episodes on student loans over the years. And this year, dude, Broheim, I have never seen so many important updates for student loans happening all at the same time. Massive 2026 updates. The old programs are gone. They're dead. Court ordered. There's another change that happened January 1st this year that almost nobody's talking about. And multiple different changes that took place on July 1st of 2026. And in October, there's going to be a new change that only has a 90-day window for you to pick your student loan program. And that will completely affect your home buying power. And most mortgage professionals, they don't even know this is coming. So let me start with the basics on how a student loan works on your balance sheet. Because there's a myth that everybody thinks, dude, there's no way anyone's going to give me a loan for a house when I have this beast of a loan on my balance sheet. That is wrong. That is incorrect. That is not accurate. Think of it this way. Your student loan is just another form of monthly debt, like a monthly car payment or a credit card monthly payment. Your total number, that's not what anybody uses. What's important is how they're going to calculate all of your monthly debt numbers. That's the only thing that matters. And there are plenty of options that can still work for today's first-time homebuyers. And it's very easy to see why people would just assume that student loans are the main reason why so many people out there with that burden on themselves, they can't afford a home. I mean, if your parents graduated, what'd they get? A degree, some poor decisions, a hangover, and that's about it. But today, student debt totals, they're freaking crazy scary. 1.87 trillion, that's with a T. There are 42.6 million people out there carrying an average of $40,000 in student debt. And $40,000 can be a scary number if you don't understand how the home loan approval system works. And people are doing it. The National Association of Realtors reported that 33% of recent home buyers, they had student debt. And even the younger ones, they're younger millennials, ages 27 to 35, 39% of them had student loan debt with a median balance of 30 grand. And for the older millennials, 36 to 45, 27% of them had a median student debt of $40,000 and they still bought a home. And hey, I know some of you folks who got high-end degrees, $40,000 in debt, it sounds like couch cushion money. What's important for you to realize is that the total, that is much scarier than the monthly numbers that the lenders are looking at to give you a home loan. Over the last 7 years at How to Buy a Home, I've coached people with fatty student debt. People with PhDs and doctorates and medical student debt. That stuff is huge. We're talking like people with $100, $200, even $300,000 in student loans, and they successfully purchased their first home. So one more time, the myth that your total amount of your student loan debt affects your ability to buy a home, totally wrong. The Urban Institute reported that over the last 25 years, when student loans suddenly became a crazy national crisis, homebuyers who were 30 years old with student loans, that number of them is higher than 30-year-olds who bought without student loans. Yes, you heard that correctly. The reason for that is because the degree usually comes with the earning power that gets you to be approved for a house. The debt, it's just the cost of the tool, and the tool works. And speaking of tools, remember these facts about student loans buying a home the next time you hear someone on social media, some tool saying, okay, boomer, whatever, we can't buy homes like you did because we have student debt that you never had. Now, I don't think they're a tool for expressing their anger, their passion, or their frustration, but I wish that they would research the facts for, 5 minutes. It's happening. It's real. So let me tell you how people are doing it. Your total student loan debt, that's not the issue. A loan's based on one thing. Can you handle a new monthly mortgage payment? Whatever that number turns out to be. So forget your total debt on your credit cards, your car, and your student loans. Nobody's approving you for a home loan is looking at your total gross debt. So it's time that you stop looking at it. They determine your loan based on your monthly debt to income ratio. That's what we call your DTI, debt to income ratio. You get that by adding up your minimum monthly debt payments. Add that to your new monthly PITI mortgage payment, which you're going to estimate with your team. And then you divide that by your gross monthly income before taxes. That's how you get your DTI, your debt to income ratio. Currently, the DTI for first-time homebuyers to get approved for a home loan, it's all the way up to 50%. And for a lot of people, that's what it's going to take to get into an affordable option. So your DTI, your debt to income ratio, that's all they care about, not your debt totals, including your student loans. There's more details on DTI in episode 504 if you want to get that formula locked in. So it doesn't matter if your total debt is $3,000, $30,000, or $300,000. You don't get approved based on that gross. You get approved based on how your payments affect your DTI, including student loans. So let me give you a real life example to explain how this works. This is going to help you see how creating your own personal best debt to income ratio for your home loan, it is totally not a linear process. It's a 3D puzzle with tons of moving variables. This is going to help open your mathematical mind so you can see there are multiple different options to adjust your DTI, including with your student loans, so you can be approved for a home loan that works for you. Now, in this example, you're going to see two ways to buy a home with twice the national average of debt. I'll do $80,000 in student loan debt. Now, in these two examples, one of them is a pure fantasy, and the other one, it's a reality, and it's only a phone call. This example's a little extreme, but I'm doing that on purpose so you can see how these 3D puzzle pieces work. So meet our buyers. They're married with 2 kids, and they have a combined income of $125,000 a year. Monthly, that works out to $10,417 gross before taxes. And they're shopping for a home. We'll just go with the median price right now, $440,600. Here's their debt. They have a car loan. It's got $23,957 remaining. It's at 6.5%, and it costs $1,067 a month. Their credit cards, they've got $8,333 total, and their minimum each month is $250. Student loans, I already told you, was $80,000, and they're paying $629 a month based on an income-based repayment program, also known as an IBR. So their total non-housing monthly debt, $1,946. So here's the math when they're trying to figure out how to get that desired home at $440,600. If they're using an FHA loan that's only 3.5% down, their full housing payment, full thing, that's principal, interest, mortgage insurance, taxes, and their homeowner's insurance, At a 6.6% interest rate, the house payment is $3,546. Add their debts, $1,946, to that payment, $3,546, and then you divide that by the gross income, $10,417, and you get a debt-to-income ratio of 52.7%. Most of the time, that's going to be denied. So they can't buy a home right now because they've got too much debt. So let's look at two scenarios where we're going to move the puzzle pieces of their DTI. Scenario number one. Oh, it's got to be the student loan, right? So in this one, we'll say that a magic money genie suddenly appears to them and it erased 80 grand of student debt. Gone. Poof. No more. Now they remove a $629 payment each month, and now their monthly debt payments are only $1,317. Now their debt-to-income ratio, it's 46.7%, and for most of the loan programs out there for first-time homebuyers, they're approved. Now the second scenario, no genie, no wiping out of the $80,000 in student debt. In this one, they make a phone call and they restructure their car payment. They call up their credit union or someone else who's given them a refinance option on their car. They refinance the payment. They take it down from $1,067 a month to $429 a month. So their new monthly debt is now only $1,308. Get this. That's only $9 less on their monthly DTI than if a genie paid off the $80,000 total. Their new DTI, that would be 46.6%. They're also approved to buy a home. See, when you understand the DTI formula, you're going to see all kinds of nonlinear variables when it comes to paying off your debt and getting that number down so you can get a home loan approval. I mean, I would even look at it like this. If a magic genie showed up and said, here's 80 grand for your student loans, I'd go, hey, well, can we use the $24,000 to pay off the car loan completely? Because on our DTI, that would wipe out $1,067. That totally reduces our DTI. If we did that, then it'd only be down to what, like 42.2%, and we qualify for a home loan. And then I know that you were going to give us, a full $80,000. So we'll just use $24,000 of it, and we'll go ahead and keep that student loan payment at $629 because we still qualify for the loan. And we'll just go ahead and use the remaining $56,000 of your magic genie money. We'll take that in cash. If that's cool, Mr. Genie, Bitcoin, I don't care. Just give it to us. There's so many different variables when you understand how the DTI works. I mean, we already figured out you could do it yourself just by making a phone call, but what if you decided actually to trade in the car for the remaining cash value and buy a used car at that price? No payment. Well, there you go. Now, you did that all on your own and got rid of $1,067 worth of payment that's crushing your DTI. Now, in this scenario, of course, you don't get the $56,000 of magic genie money, but you get the idea. I tell people all the time, hey, you got a big old car payment? Trade it in, cash it out, get rid of that payment. That's going to buy you hundreds of thousands of dollars worth of home. So that's the important thing. Understand that 3D puzzle of your monthly DTI. There are a million ways that you can move things around when you comprehend the way that the banks are looking at your monthly debts. The lesson here is, even though your student loan total amount might be high, its effect on your ability to buy a home is based solely on the monthly payment, which is why the second half of this episode, with all the brand new changes in 2026, it's going to be very important. That's coming up in a bit. So hopefully you're wrapping your head around this right now, but let me give you a rule of thumb that I use to help people look at their monthly debts. Now, bear in mind, this is not an accurate formula. You can't take this to your bank or your lender. Lenders hate when I quote this, but it helps people understand and grasp the concept when you're trying to create your own debt to income ratio and figuring out your own formula and what's going to work. I want to be really clear. This is a rule of thumb. This is not a quote. It's not an accurate measure. Do not print this out and take this and show it to anybody. Or I guess don't go to your parents' house and print this out. This will get you in the neighborhood and most importantly, give you a mathematical understanding of how your monthly debts affect your home buying power. Right now, at today's interest rates, roughly $800 a month. That buys you about $100,000 worth of home. That's using the general formula of a 3.5% down payment, 6.5% interest rate. And at that formula, $800 per $100,000 of home. That $800, that's going to include everything: your principal, your interest, your taxes, your insurance, your mortgage insurance. And that's a formula you can use. And again, this is no way a hard and fast, accurate formula. It's a basic estimation, and it can fluctuate a lot, especially based on interest rates and, most importantly, in your local tax rate. But this will help you to start looking at your minimum monthly debt obligations and how they affect your home buying ability. Now you're going to look at an $800 car payment and think, damn, that's $100,000 worth of house for our approval. That just lowered our ability to buy by $100,000. That's the trade that you made. And unfortunately, when you bought the car, nobody told you that's what you were doing. And you can do the same thing looking at a credit card payment. You got a $400 minimum credit card payment. That's $50,000 worth of house that you're not going to be approved for. So what I'm trying to do is help you step up your strategic game. There's a new mindset for how the new first-time home buyer in today's rental and housing market has to buy. If you look at the DTI example that I just gave you with the car refinance, if you took that to a financial advisor, most of them would tell you not to do it. And they'd have a good fiscal reason for doing it. Because the car refinance, if you just look at it on its own, yes, it's a bad financial move. You'd probably be going from a 6.5% interest rate on your car loan to an 8.75 and stretching that term out. That's a bad financial decision on paper. If when you look at it just in isolation, yeah, that's a worse loan. They're not wrong, but they are not looking at the whole picture, especially for today's renter who wants to start building real wealth as a homeowner. Because right now we have an entire generation trying to do everything right to become homeowners, looking for advice everywhere. But they feel like they're failing at a game that they look around, they see some other people seem to be winning. Well, I want you to hear this now. You're not failing. You're just getting advice from people who don't understand the new playbook. The old financial playbook, it's got rules that worked in 1995 for a world before student loans blew up and where your rent didn't outrun your raises for like 15 straight years. The problem lies in this. Most financial advice, it's geared towards what people do with the money that they have left over each month, left over after rent. And that is the big miss for people in today's economy. Rent is the hole in the bucket that's draining what you're trying to put into the bucket. All the financial strategies are inconceivably ignoring the gaping hole of rent. It's your biggest payment, the most money you put out every single month, and it buys you nothing, builds you nothing, and it comes back bigger every single year. People out there, they're looking at a $2,500 rent payment versus a new $3,500 mortgage payment, and they end up looking at it wrong. It's not spending $1,000 more each month. It's putting all $3,500 to work instead of zero. Now that lost $2,500 a month, which gained you nothing, it's going into an asset that appreciates. It's a forced savings account, and it hands you tax benefits. And the reason all the financial gurus out there, they're not giving you this advice, it's simple. Because nobody makes a dime explaining that to you. They make their money with the money that you have left over. Financial people, they want to give you advice to grow that. And so they conveniently ignore the formula with the huge loss of rent. And that's exactly why I use this extreme example to explain how to move your puzzle pieces for your own DTI. Because yes, refinancing means that they probably pay about $5,000 more total interest over the life of that car loan. So technically they're not saving money, but what they did do is they bought home purchase qualification. Run the trade-off numbers, $5,000 in extra car interest, that bought them an extra $83,000 in house. Plus, it utilized the years of lost rent payments that they would have had to continue to pay while they delayed their home buying, trying to make the formula work and get qualified. So student loans fit in that same bucket. They are a piece of your DTI, not an approval killer. Use this insider knowledge you now have to understand you're not falling behind. You are now informed to be well ahead of the curve. Uninformed people, they never apply for a home loan because they've already decided the answer is no. They deny themselves before they know everything. And that has to get corrected. I don't want to see generations denying themselves and being left behind without understanding this full formula. Right now in our country, we don't have a loan approval problem for first-time homebuyers. We have an information problem. So let me give you some more information. The St. Louis Fed just published a study in May 2026. It analyzed over 35 million mortgage applications. And here's what actually was causing denials. 35% was debt-to-income ratio. 28% of denials, that came from the credit history. 9.9%, that came from collateral, which means the house had problems and was deemed something that you couldn't get a home loan on. 7.2% was unverified financial information. 6% was someone not completing the full application. And 5.3% was they didn't have enough cash to close the deal. Now, did you notice something in all of that? Too much student loan debt is not on the list. It's not a category. It's just a piece of the DTI. And for most of you, it's not hitting as hard as you think. So that's the formula for student loans. That's the myth buster I've been sharing for years on this microphone. And, if this was a regular year, I would normally just stop the podcast right here. But holy shit, do I have a lot to tell you about the insane amount of changes in student loans happening in 2026. And most of them directly affect your monthly payments and in turn, you guessed it, your DTI. Now, some of these changes are great for first-time homebuyers, but some of them, they can be apocalyptically bad if you don't take action. Here's what's going on. In 2026, if your credit report isn't showing a current monthly student loan payment, if it shows a 0, when you go to buy a home lender has to convert it into monthly payments to see how much home you're going to be able to qualify. And if they don't know the new rules for 2026, it's going to change your approval numbers big time. Now, let me give you a little trigger warning right here. The rest of this podcast is going to get pretty damn granular. And I'm not doing it to show off my mad nerdy skills. I'm doing it because the difference between two of the details that I bring up a little bit later on, it's like the difference between $30,000 or $100,000 in house. And that's just the tip of the 2026 student loan iceberg. Things have changed. I have to get detailed for your benefit. So if you're listening, you don't have a student loan, I'm going to use a lot of student loan terms and a bunch of it's going to sound like gibberish. But for those of you that do have a student loan and you're dealing with this, listen up. There's a lot to cover. Now, you might want to listen to this a few times or go back to the How to Buy a Home website and check the episode blog, the post on this particular episode and reread some of this because it's going to get intense. All this started a few years ago because student loans and the payments for them, they were significantly altered by that post-COVID plan called the SAVE plan. There was loan forbearance, deferment, and some people even got forgiveness. Well, as of August in 2026, the SAVE plan, it's dead. It's legally, formally dead. And in 2026, it has been replaced by what's called the new tiered standard plan or income-based repayment, income-driven repayment, or the pay-as-you-earn program, or a new program called WRAP. I'll explain all that stuff in a minute, but as an aspiring homeowner, what's important to you is to understand which program you select. This has an enormous effect on your home buying power. And this is what's crazy. The selection process, if you're not already in one of those, it starts in October, and you only get 90 days to choose a plan. And if you don't select one, you're going to automatically be put in the most expensive plan, the one that effectively kills most of your home buying dreams. So I'll start with this. For those of you buying a home before the end of the year, if your credit report shows a 0 student loan payment right now, and this is where millions of you are because of forbearance and deferment options, here's the thing that I can't find anybody telling you. This should be on the news like 24/7. For a home buyer with student loans, reporting is 0. Most of the time, you do not get to use that 0 on your debt to income ratio. That is a gigantor fact if you're thinking about trying to buy a home this year. I mean, what do they use if all you're looking at is a 0? Here's how it breaks down. There are 6 major home loan programs. And what's crazy is they use 4 different formulas to convert that zero from your student loan debt into a different number that they're going to calculate for your DTI. 6 programs, 4 different formulas. And the gap between the formulas, it can be hundreds of dollars a month. And that could be the difference between $50,000 or $100,000 worth of your home loan approval. The 6 loan programs are this: Fannie Mae, Freddie Mac, FHA, USDA, and VA. Now, if you're counting, I know that's only 5, but that's because one of them uses 2 completely different loan programs. Here's how each one of these converts your zero payment into a payment that goes against your DTI. Starting with FHA, Freddie Mac, and USDA. Those 3, they all do the same thing. They use a 0.5% of your outstanding balance. And then here's where it gets funky. The Fannie Mae loan product. This one's the outlier because this one had some major changes, so listen up. If your lender puts you into a Fannie Mae loan product, if you're currently on an income-driven plan and you can document that your actual payment is 0, then Fannie Mae is the only program in the country that is going to use that 0 for your DTI when you're qualifying for a home loan. That's a big win for you. But here's a big warning. If you get put in a Fannie Mae loan and your loan's in deferment or forbearance, Fannie Mae, they're going to use a full 1% of your balance, not the 0.5% like the first 3. And 1%, that's the highest percentage of anybody. So what's funky is with the same lender, you could have 2 completely opposite outcomes depending on where your student loan is sitting right now, if it's an income-driven plan or if it's in deferment or forbearance. And that distinction is worth big money. And it's a kind of thing that a lot of loan officers out there, they're getting wrong. And then finally, the 5th program, which technically is giving you the 6th option, this is for the VA. This is only for military and veterans, and it has some unique differences. Cool thing is, it's the most generous of all when it comes to if your loan's on deferment. If you can document that your student loan is currently deferred at least 12 months beyond your closing date, then VA, it doesn't count a payment at all. And there is one more thing that VA does, which is technically, I guess, a 7th one, but not everyone's eligible for a VA loan. But I'll tell you this one, if you are, if your loan is in a repayment program right now, VA uses the greater of either your credit report payment, whatever they're saying right now, or 5% of the balance divided by 12, which it sounds actually high, but it's really a good deal. Okay, who's majorly confused? I know that's a crazy amount of numbers and formulas, but if you're buying a home this year, you kind of need to get a really good understanding of this. So let me give you an example. I'll use a $60,000 student loan. And I'll show you what it looks like if you have a balance that's showing 0 right now. And I'll show you what it looks like on a documented income-driven plan. Okay, with FHA, Freddie Mac, and USDA, if you're on an income-driven plan, you get 0.5% of $60,000. That's $300 that you're going to use for your DTI calculation. Now on VA, that's the really crazy one. We're going to do 5% of the balance divided by 12. It's $250. That's good. But here's the big win for you. If you get your lender to use a Fannie Mae product and you're on an income-driven plan that shows 0, Fannie Mae is going to count 0. And you can use that for the rest of this year. So it's the same borrower with the same house, and it could be a $300 a month swing in your DTI purely based on what loan program your lender puts you in. So I told you guys, this is going to get into minutia, and I'm going to use all my home buying super nerd powers to show you all the details because this stuff is critical for you because the right loan with the right student loan program, it can cosmically change the power you have as a buyer. And there's more. There are ginormous immediate changes happening the rest of this year that are going to have a real impact on anyone with a student loan who wants to buy a home in 27 or 28. Because for the last 2 years, thanks to the SAVE program, millions of borrowers have been sitting in administrative forbearance or deferment, and you're sitting there with a payment of 0. And that's created a new 2026 zero payment trap. And I have to make sure that everybody knows about this, talking to you people who are looking to buy a home in the next year or two. Because if you're praying for forgiveness or some new government plan to come in and keep that zero going or wipe it out, as of right now, that's not on the table. And that's not even the worst part. Because as of August, right now, 2026, if you're on save, you're going to be getting a letter that comes to you by October 2026. And when you get that letter, you have 90 days from that letter to select your student loan plan. 90 days, that's it. And if you want to buy a home, you absolutely cannot ignore this. And I want to be super clear about this. 90 days, that's your clock to pick a new program. It's no joke. Because if you do nothing, they've slated that as early as September 29th, they can automatically auto-enroll you into the standard program or the new tiered standard plan. And those, not good for first-time homebuyers. They're fixed payments based on your balance, not your income. It's based purely on your balance. That can crush your DTI. So if that happens to you and you don't select one in those 90 days, you're going to get thrown into those auto-enrolled and you can kiss your home buying dreams goodbye. So I'm going to go full UNC mode here. I know that over the last few years, a lot of you have gotten used to ignoring your student loan mail. And if you keep doing that this year, you're going to torch your DTI, which is going to crush your home buying dreams. If you're house hunting in the next 6 months to 3 years, here's a warning from UNC. Open all your student loan mail. Treat the letters you get as home buying documents. Open it, call your lender the next day, and start a discussion where you're comparing the plans. I can't tell you what the best plan for you to do is because I don't know your full financial picture. I can't tell you what the best plan for you is. I don't know your full financial picture. I just want to make sure that you're lined up because you're listening to this, which means you want to be a homeowner. Everyone out there is going to have a different best plan. I can't emphasize that enough. In fact, you know what? Forget what I said. Don't wait for the letter to call someone. Call now. Get a first-time homebuyer specialized real estate support team and start building a strategy like you want to buy a home in 3 months, even if you're going to need 18 to 24 months, because what that's going to do is it's going to help you force yourself to pick a student loan program by the end of the year. And if you're buying in 27 or 28, you have to do that to make sure you're lined up correctly. So forget what I said. Call someone now before the letter happens. This is all brand new. And I'm telling you, nobody's got a handle on this. The sooner that you start working on this, the better you're going to be able to adapt because the lending industry, they're going to be playing catch up real fast. And the new lending guidelines, they're going to be adjusting as everyone's figuring out what's going on with these sweeping changes. I'll tell you what I found out so far. I did some research on 4 of the plans, and I'll give you a general cheat sheet. Run this over with your people and figure out which one's best for you. And remember, I'm only looking at these plans through the eyes of someone who wants to buy a home. This isn't about reducing the debt as quickly as you can. People who are looking and trying to figure out, okay, what payment is going to reflect best on my DTI? That's what you're looking at. So don't ask your friends or Reddit or anyone else which new student loan program is the best one, because you're going to get a bunch of answers that truly are not your answers as an aspiring homeowner. It's all about our friend DTI. And this stuff is so new that once you take it in, listening to this right now, you're going to know more than probably the person answering your phone at your servicer. So let's get started. Number 1, the new tiered standard plan. This is one that you get dumped into if you ignore your mail, which is why I keep yelling about the mail like some crazy old man. For a potential home buyer, most of you out there, you don't want this one. It's fixed payments based on your balance, not your income, no adjustments. They just toss you in a tier, and that will totally tilt your DTI in the wrong direction. The second one, this one's pretty complex. It's called RAP, the Repayment Assistance Program. This literally just launched July 1st of this year. And every first-time homebuyer out there, you need to comprehend how this one works because it's different than any other student loan program before. And even the mortgage pros, they don't know how this one works with a home loan yet. I'm just giving you the information I found. I am not a student loan expert, and I am definitely not a home lender. I'm just a real estate nerd looking out for you first-time homebuyers. So I'll give you the facts, and then you got to run it by somebody to know what's going to be best for you, to know if this is good, bad, or indifferent. And remember, the clock's going to be ticking. Those of you who are familiar with some of the repayment programs that are based on income, there's a big change in this one. The formula for RAP, it creates your payment from a straight percentage of your adjusted gross income. It doesn't use your discretionary income. It's a straight slice right off the top. So depending on how much you make, you take a percentage of your annual gross income, the full thing, and you divide it by 12. That's your monthly bill. Works like this. So if you make between $20,000 and $30,000 a year, that's a 2% you're going to use. 30 to 40, it's 3%, and on and on. 1% per $10,000, and it maxes out at 10% when you're at $100,000 or anything over that. So I know, confusing. Here's the example. If you make $45,000 a year, you're in the 4% bracket. 4% of $45,000 is $1,800 a year. Divide that by 12, your number is $150 a month. Now, if you make $105,000 a year, then we have to use 10% of that. And that's $10,500 divided by 12, $875 a month. So if you're over six figures, this can get chunky. Oh, but you do get a very generous $50 a month off for every dependent that you claim. I was being sarcastic. That's not great. Now, if your money that you pay doesn't cover the interest, one of the things that's nice is the department waives the unpaid interest. So no more negative amortization. No more, man, I've been paying my student loan for 10 years and my balance went up. That horror story, that ends with this. And yeah, that could be a good change for you. And another thing it does is if your payment knocks less than $50 off your principal, they credit you the difference. So you're always getting $50 a month off your principal. That way, everyone on RAP is moving the needle in some way or another every single month. But then here's some things that you need to be aware of with this one, because they might burn you if you're not sure how this whole thing works. The forgiveness for the loan, it moves to a 30-year, 360-month plan. And the credit on that, it's a one-way street. Payments that you made under your old income-based repayment program, if you were in an IBR program or a pay-as-you-earn, also known as a pay program, or an income contingent repayment plan, an ICR, well then, if you go into RAP, those old payments, they count towards RAP 360. But the payments that you make going forward under RAP, they do not count backwards towards the IBR, the pay, or the ICR forgiveness. So if you're deep into an older plan's forgiveness clock, moving to RAP, it could cost you years. Another silly thing about this one is there is no grace period. If you're 1 day late, you forfeit that month's interest waiver and the $50 principal match and your forgiveness credit for that month. So if you do end up using RAP, set up autopay immediately. That's just some of the details on RAP. As a potential home buyer, the thing you need to realize is if they're just taking your balance and your balance is significant, it's going to be something that probably is going to be a bigger number against your DTI. Income-based repayment. This is a great one. This one survives permanently. And this one, it's really the legacy plan for a lot of people with student loans. Keep in mind, if you're a brand new student loan person, the IBRs, they only work if your student loans were dispersed before July 1st, 2026. The way it works is if you're pre-2014, it's 15% of your discretionary income and it has a 25-year forgiveness. If you're 2014 and beyond, it's 10% of your discretionary income and a 20-year forgiveness. And here's a genuinely good piece of news that got almost no coverage. You can now enroll in IBR regardless of your income. A lot of times, if you made too much, you couldn't get an IBR program, but that gate is gone. So if you got told you couldn't do it before, ask again. This is an actionable solution that you can do right now. And here's the big difference between IBR and RAP. RAP takes a percentage of your whole income, top to bottom. IBR only counts the money that you make above the poverty line. So for a single person in 2026, IBR, it just ignores the first $23,940 of your income. Doesn't count it. And if you're married with 2 kids, it ignores $49,500. What happens if you're in RAP and you've got 2 kids? Oh, they give you $50 a month for each one. IBR gives you almost 50 grand of protected income. Now, there is one trade-off I found. IBR wins on monthly payments at these incomes and has a shorter forgiveness clock. That's great. 20 to 25 years versus RAP's 30. Usually you're going to trade one for the other. But here's the trade-off. RAP waives your unpaid interest and adds up to $50 a month towards your principal. So it can, if you aren't looking at the full numbers for your full payment, then there is going to be a trade-off there. Let me give you some real numbers for a home buyer. Okay, so first we're going to start with Maya. She's single. She's a nurse practitioner. And Maya makes $110,000 a year. She's got $80,000 in student loans. She's got a $450 car payment and $100 in credit card minimums. Now on RAP, her student payment is $917 a month. On IBR, income-based repayment, same woman, same income, same loan, it's only $717 a month. $200 off her DTI just for filling out a different form. On RAP, Maya only qualifies for about $385,000. On IBR, she qualifies for about a $411,000 home. $26,000 more house. Again, same woman, same income, same student loan debt. Now I'll run the numbers with the family. We'll have Marcus and Dee. They're married, 2 kids, and they have a combined $120,000 in their annual income, and they've got $80,000 in student loan between them. They're going to file jointly. On RAP, it's $900 a month that they owe to their student loans. On IBR, $588, $312 a month difference, which turns into $47,000 more house. They go from qualifying for only a $421,000 house to qualifying for a $462,000 house. They get 40 grand more house just because of filling out the form. And hey, I told you there were some trade-offs, so let me give you a way out there mathematical example to show you how to use this program, even if you've got a $300,000 student loan debt that you owe. For people factoring in financial benefits and all the math of buying a home and calculating a full rent replacement strategy, there are still options even with that big a balance. So we talked about Maya number 1. She's a nurse practitioner making $110,000 a year and paying $717 a month on that $80,000 worth of student debt IBR program, right? Okay, now we're going to take Maya number 2. She also makes $110,000 a year, but Maya number 2 went to extended medical school, and she's just starting out on her career as a specialized doctor, and her student loans are $300 grand. So for the first year, both Mayas make $110,000 a year, and they're on an IBR, an income-based repayment program. They're both going to pay $717 a month. But Maya number 2, her loan, which has a $220,000 bigger balance, it's going to accrue $1,625 a month in interest. So even though she's paying on time every month, her balance is going to grow about $908 a month. So for Maya number 2, if she enrolls in this program, that's 11 grand a year when she's paying on the IBR, which means for Maya number 2, this is a strategy question. She has to look at nonlinear calculations, and they have to include the rent replacement strategy numbers of home ownership versus renting. You want to look at those? The full breakdown's in episode 460. So Maya number 2, she's looking at this $11,000 a year trade-off. $11,000 more in interest in the first year. Yeah, that's big. But then she factors in the fact that she'll also stop paying $2,800 a month. And she's also going to get all those compounding gains from starting the clock as a homeowner this year. Well, she knows she's going to be making more money as her career advances. So for her this year, that math works for her. To use the lower payment to get approved and start building her net worth. She can factor in future payments to her loan later on when she starts to make more money. Her goal is not to be debt-free as fast as possible while continuing to rent. And that's the big difference. Her goal is to own a home as soon as possible for the better financial outcome. So with her math, doesn't matter. Again, this was a really extreme example. But you can look at your 3D jigsaw puzzle because buying debt-free to buy your first home, it's just not an option for most first-time homebuyers in this new economy. But there are plenty of financial winning strategies when you mathematically calculate your rent replacement strategy, even with all different sizes of student loans. I'm all about the real. I'm all about factual solutions and the strategies for first-time homebuyers to get ahead of the curve and beat the rigged game. They are slightly more complex than the old boomer plan. Save money, buy a house young, sit on it, and then you have a gold mine in your 60s. But the new formula, it's got more variables to build your roadmap, because we all still want the same golden years gold mine. We just have to figure out a new way to get there. I'm laying out the foundations here for you, and I highly recommend that you hire a killer, unicorn, first-time homebuyer, specialized realtor and lender to go through all your options. Student loans and home buying, they're not a thing to guess at. But with the right team, you're going to be surprised about the options you've got. Since I'm here to make sure that you're getting all the right information, let me give you some more warnings I found in my research. 2026 is nuts. Thanks to all the zero down payments that are happening over the last few years for student loans, there's a lot of talk about consolidation. This is brand new. After July 1st, 2026, do not consolidate your loans without written servicer confirmation that you can keep your old income-based repayment plan. Because for a home buyer, most of you are really going to want to keep that plan. But after July 1st, 2026, it's not necessarily guaranteed. And speaking of consolidations, as for consolidations in general, I've talked a lot about them over the last 7 years. I've always warned, consolidation sounds good in principle. It's fiscally responsible. You got multiple loans, you want to consolidate them and simplify things. This is a great debt reduction tool. Very good if that's your main objective. But any consolidation, if buying a home is your main objective, it can actually hurt your chances. And in 2026, it's way more serious than that. And this is the kind of thing that's going to haunt you for decades if you get this wrong. Because a student loan consolidation dispersed on or after July 1st of 2026, you become a new borrower. That means that you are stripped of your access to every plan except RAP and the tiered standard. You do not have the option for IBR, PAYE, ICR, all the income-driven plans that end up being best for first-time homebuyers. And you can't get the 10-year standard or the extended program or the graduated program. If you want to buy a home, none of those are an option for you. You only get RAP or tiered when you consolidate after July 1st, 2026, and that's no bueno for you. So if buying your home is your goal, I can't stress this enough. Include your lender in all your decisions about paying off your student loans and what plan you're going to get into. Just do it. Period. The end curtain. If you don't, you may be doing a great job reducing your student loan debt, but you're going to ruin your home loan approval and your purchasing power. It's a balancing act. It takes expert guidance. Okay, next one. This is something I've heard a little bit about, and it comes to how you file your taxes. Married filing separately, that's a loophole because it excludes your spouse's income from IBR. It's up to you to figure out whether that reduction that way is greater than the loss of tax credits that you would get from filing jointly. But this is 100% tax pro territory, not podcast host territory. So seek professional assistance if this is what you're thinking about. Another new one. IBR requires annual income recertification. So recertify as soon as you can before you apply for a mortgage. Definitely not during that period. This can kill a home loan mid-search or worse while you're under contract for a home. So add this of your to-do list things that you've got to do in your pre-planning phases when you're looking to buy a home. Next one, if you're currently enrolled in the Pay As You Earn, the PAY program of the Income Contingent Repayment Program, they're officially set to go away in 2028. So at that point, you're going to have to convert them to RAP or IBR, the Income-Based Repayment Plan. That's the rules today. Who knows what's going to happen between now and 2028. But very important reminder, this is not the same as that 90-day letter. Don't think about 2028. Your real deadline is going to be 90 days from when you get that letter. When you do make your choice, make sure your servicer puts it in writing. And the last tip from these warnings, if your first loan was distributed on or after July 1st, 2026, congratulations, college grad. You only get two choices, wrap or tiered standard. Whoa. Okay, hey, still out there? You still awake? I've either bored you to sleep or I've shocked you into a state of petrified panic. That's a lot of new information. So I'll tell you what, I'll break it up right now. Here's a dad joke to wake you up. What do your student loans and your gym membership have in common? You keep paying it every month and you're too scared to call and change your payment. Terrible. All right, that is definitely not my best dad joke, but the source material did not offer me a lot. Okay, so after all of this, your brain is probably fried and you're thinking, Sidoni, man, just tell me, what's my best solution? You know what, dude, I've got no clue. The ball is in your court to find out. And I hope you take this to heart because I am always straight with you guys. No housing agency out there, they haven't given any guidance on this. This is all brand new. I looked at the 2026 FHA mortgage letter information bulletin, the Fannie Mae announcement and letters and everything they send out and everything Freddie Mac sent out in their bulletins. There wasn't one word about wrap. So that is why you do not Google this and you don't ask AI and you don't ask your buddy who bought a home in 2019. Nobody has enough data on this stuff yet. Unfortunately for you, you only get 90 days to make your choice. There is no best program that anybody can definitively say for this new frontier. The reason I'm sharing all this data today is to make sure that you're informed, but most importantly, to make sure you start a conversation before you enroll in anything and definitely before you apply for a mortgage. So if you're trying to figure out which one's best for you, let me give you something that you can do. Take the information here, give it to your lender and say, run my student loan payment under every plan that I could qualify for against every loan program that I could qualify for and show me the grid. Run it every single way. I want to see if I have options to buy a home. Here's a couple detailed questions you could ask them. One, if my income-driven payment calculates to zero, does the program that you're putting me in actually honor that zero? Now, there's only one of them that does it, Fannie Mae. The FHA doesn't, and the other ones don't. They put you all at 0.5%. So that could be a big difference. So make sure your lender understands which one they could put you in and if they can keep you at zero. And the second question, if my current zero is coming from a plan, where's it coming from? Is it coming from an IBR plan? Is it coming from forbearance? Is it coming from deferment? Because those are majorly different kinds of zeros. It could be a documented zero, or it could be forbearance, or it could be deferment. And those are going to be totally different things to an underwriter. Once you go through all this and you figure it out and you pick a plan, make sure you get your student loan servicer to give it to you in writing. Now, I'm telling you, a lot of lenders out there, they're not even thinking about this. So if you come in bringing me these questions, this is going to elevate you from an average buyer to a, beyond exceptional, super duper well-informed buyer. Because almost nobody out there is running grids like this for first-time homebuyers because this all just happened. And the grid, it shouldn't make you discouraged. It should make you optimistic. Options are the things that help you win as a first-time homebuyer. Okay, I've got one more warning. I'm always dropping truth bombs here. This time it's a tax bomb. It might blindside a lot of you. The American Rescue Plan, it made forgiveness student loan debt federally tax-free, but it ended at the end of 2025. It wasn't extended, meaning we're coming to the end of 2026 and you're going to get ready to do your taxes. If you had a student loan forgiven, you might get a 1099, which adds that forgiven balance to your income. That's just your unc telling you this. Definitely don't take my word for it. Call a tax pro and see if this is going to affect you. And now I'll be the fun unc with some good news. Don't sleep on this because this could be a money saver. Again, this is another one that started just July 1st, 2026. The Department of Education announced a 1 full percentage point interest rate reduction for borrowers who enroll in auto debit. So if you automate your payment, that's a huge bonus. It's usually only a 1/4 point. So this is big savings. It applies for direct loans first dispersed on or after July 1st, 2012. And this could be for students and parent borrowers. But the deadline to sign up is crazy quick. It started July 1st, but you have to be enrolled by September 30th, 2026. That's 6 weeks from when this episode drops. And if you owe $50,000 on your student loan, a full point using this auto debit pay, that's $500 a year that you save just for filling out this form. Now, if you're still in save or you're in default or you're sitting in any kind of deferment or forbearance, there are steps you have to take first because the auto pay needs to have an actual scheduled payment to pull from, and you don't have one right now. So if you're in those programs, you gotta call your servicer. But if you're in good standing on any of the legitimate ones, if you're currently in the recognized repayment programs, RAP, IBR, tiered, standard, PAYE, ICR, standard, graduated, or extended, if that's where you are right now, pause the episode, set up auto pay, make some more money. Go ahead, pause. I'll wait. Okay, I can't talk about student loans with talking about this one. I saved this for last because this one's about damage control. I want to help you get ahead. Because what happened is post-COVID, lots of you got to stop payments for a while. When that ended, and it did, many of you didn't get back on a payment schedule and your credit score got hammered. So I want to help you get back on track because continuing to ignore this is going to be pushing your home buying dreams back by years. And hey, if this is you, don't beat yourself up. You are in no way the only one here. If misery loves company, then you have millions of people to love. So I'll explain this to you like a fun story or a movie where the universe looks screwed, but the Avengers come in and save the day and millions of people that got turned to dust come back to life. Our story begins in September of 2023 when loan interest resumes. Now, you did get a 12-month on-ramp where missed payments were not reported to the credit bureaus, but that ended September 2024. In October of 2024, late payments started to count for the first time in a long time. And I've got the data on it, and it's brutal. As of March 2026, roughly 9 million student loan borrowers are in default on $220 billion. And no, my friend, you are not alone on this, not by a long shot. And I know people's credit scores got tanked. And the people who got hit the worst were the people with good scores. People with below 620, they dropped an average of 74 points. People with scores 620 to 719, they dropped 140 points. And you people with scores over 720, they dropped an average by 177 points. The people with the best credit scores got hurt the worst because they had the furthest to fall. This all sucks, so what's the solution? Here's my big plea to you. For the love of all things holy and unholy, stop ghosting your student loan people. I'm begging you. And it's not because I'm your dad. It's because a 140-point credit score drop is going to cost you more house than any student loan balance ever will. If you're listening to this, God knows today in this episode, if you're still here, man, you are motivated. So let's get you proactive. Let's get you a plan. I tell every first-time home buyer, no matter what's going on, everybody, your first step is credit score. I don't care if you're 560 or 810. So I'm going to ask you to do something right now that my 20-year-old son hates with every fiber of his being. Call today. Pick up the phone. If you can't afford your payment, there's a plan for you. RAP has a $10 minimum. IBR no longer has an income test. There are options. Call your student loan servicer. Get on the phone. Sit on hold. Look, I know you're going to hate it, but that hour that you spend with them will be the single highest return for any time that you spend the rest of this year, probably next year too, like 100 times more. And if you're already in delinquent or default status, you know what? You're not out of the game. You need to get current or get into a rehabilitation program. And cool thing is, now you can rehabilitate a defaulted loan twice in a lifetime instead of once. But you got to start ASAP because credit repair takes time. So it's not fun, but there's two things you got to do. Stop ghosting your student loans and make sure you look at your student loan mail this year. These two pieces of advice can be the difference between you looking at other people with jealousy as you're struggling to get by, or being the person that other people look at with envy. And immediately after you make that call, listen to episode 503 on credit scores and start improving your credit score now, no matter what your timeline is to buy a home. Whew. Okay, that's all I got from my notes. And damn, that was a lot. Here's some takeaways, things to make sure you remember. Understand how your DTI works. Start moving your puzzle pieces that best work for you to become an eligible homeowner. And when it comes to your student loan, your zero payment, it could be hurting you. And getting on a real payment plan might help you tons. And remember, so many of these changes are brand new. Nobody in the mortgage industry has any guidelines on this yet, which means you have to ask. Ask them to run your situation through all the loan programs and all the student loan programs that are going to be coming up and available. Don't let yourself get auto-enrolled into a fixed payment that you don't choose. And finally, protect your credit above all else. A wrecked credit score, that's going to push your buying power back years. And don't sit in the dark assuming you're getting screwed. Nobody really knows how all this is going to work, and everyone's going to need guidance. So talk to someone, get your specialized team, get working on this ASAP. I know that was a lot, but it's important. But what I want to do now is I'll end this episode with the flurry of reality. After taking in all that intense data, you deserve to hear real numbers so you can ignore the emotion that's going on right now. There's pessimism everywhere about first-time homebuyers, but it's not based in fact. Right now, 43% of first-time homebuyers say student loans are the biggest thing standing between them and buying a home. Yet, so far this year, over 700,000 people bought their first home. So both of those things are true at the same time. The difference between the people who think they can't buy and the 700,000 who did buy, it's not income, it's information. This is the reality. First-time homebuyers for this year projected to be 1.45 million first-time homebuyers. That's the highest number since 2021. That's almost 4,000 first-time homebuyers a day. And over half of the first-time homebuyers this year so far, they closed with no co-borrowers, solo buyers on one income. The average down payment was only 9%. The average first-time homebuyer that was approved this year, they had a debt-to-income ratio of 40%. So that means people are using the rent replacement strategy to find winning math with debt, car payments, credit cards, and yes, student loans. And Gen Z, they're 1 in 5 of every mortgage lock happening in the country this year. The youngest buyers in America with the least time to save, they're setting records. So what's happening right now? This isn't a student loan crisis. It's not even an affordability crisis. It's a lack of correct information crisis. A survey this year found that 63% of would-be buyers think that today's mortgage interest rates are the highest they've ever been. They're not. That's not even close. They peaked at like 18% back in the 80s. Hell, they were at 8% just 3 years ago. We're only at 6.6 right now. Here's the really important part of that survey. 56% of the people who said that, who got that categorically wrong, they described themselves as very knowledgeable about buying a home. That just bums me out so bad. That's the actual crisis. People are not just wrong, they're confidently wrong. And with student loans, boy, that's really going to start happening a lot this year because the game's changed. Most loan officers out there, they're still quoting you debt to income with owed student loan rules. Every single one of those 500,000 buyers, they had to have someone in their corner who was keeping up with the current rules. That's their entire edge. So no, it's not impossible. It's just uncommon. People buying homes in 2026, they're not luckier, they're not richer, they just got the right information. The market, that's not the reason you're not a homeowner. Just like your student loans aren't going to be the reason either. Bad information is. And that's something we can fix. And we started that today. If you're still awake with all that math and detail. Okay, That's it. Student loans. I have more financial tips coming up in the How to Financially Prepare to Buy a Home series. We're going to talk about opportunities and possibilities. That'll be part 6. Subscribe, follow so you don't miss anything. Write a review if you can. And if you have a specific question, go to howtobuyahome.com and I will answer it if you click the Ask David button. That's me, not a robot, not AI. I need a drink. You can do this.
Looking for more DIY education or your own personal step-by-step guidance through the home buying journey? Since 2019, How to Buy a Home has been the #1 resource for first-time home buyers. So visit howtobuyahome.com to get started.